Welcome to our video on risk-to-reward ratio in trading stocks. This concept is a key part of successful stock trading, and the Walk Forward Algo Trading program for the Think or Swim platform can help you manage your risk-to-reward ratio automatically. In this video, we'll demonstrate how easy it is to dial in the risk-to-reward ratio and immediately determine the backtest and forward test profitability and win rate. The risk-to-reward ratio is a measure of how much risk you're taking compared to the potential reward. It's calculated by dividing your expected risk by the amount of return you're receiving. The lower the ratio, the better, as this means you're taking less risk for a higher potential reward. Pivot point resistance and support helps traders determine risk to reward by providing levels of support and resistance that can help traders set entry, stop loss, and target levels. By using these levels, the program automatically calculates the risk-to-reward ratio. It's important to manage your risk-to-reward ratio because it can help you maximize your profits while minimizing your losses. If you're taking too much risk, you could lose more than you're willing to, and if you're not taking enough risk, you could miss out on potential gains. The Walk Forward Algo Trading program can help you manage your risk-to-reward ratio, both for backtesting and forward testing. By dialing in the risk and monitoring both profitability and win rate labels, the ideal risk-to-reward ratio can be achieved to maximize your profits while minimizing your losses. First, bring up the settings panel by clicking on a green or red shaded area and then drag the panel down to expose the backtest and forward test labels. Adjust the risk-to-reward setting to 0.5 risk. Click on the Apply button. Observe that the backtest profitability and win rate display 27% and 60%, while the forward test profitability and win rate display -33% and 0%. It looks like a 0.5 to 1 risk to reward can be profitable over a period of time and disastrous for intraday trading. This is not the ideal risk to reward ratio. Repeat the above for a 1-to-1 risk to reward and observe that the backtest profitability and win rate decreased to 17% and 67%, while the new forward test profitability and win rate increased to 50% and 100%. Has the backtest profitability peaked? To find out, I'll increase the risk to reward to 1.5 to 1. The new backtest profitability and win rate is 22% and 82%, while the forward test profitability decreases to 40% and the win rate remains at 100%. Has the backtest profitability peaked? To find out, I'll increase the risk to reward to 2.0 to 1. The new backtest profitability drops to 17% and the win rate remains at 83%. The forward test profitability decreases to 33% with the win rate remaining at 100%. The profitability has peaked and it appears to be best with a risk to reward of 1.5 to 1. In conclusion, adjusting the risk up in 0.5% increments until the backtest and forward test profitabilities peak can help find the ideal risk to reward ratio. By using the percent of the support as 2 for long transactions and percent of the resistance or 2 for short transactions as the risk adjustment, you can determine the profitability of your trades by comparing the win rate to the break-even win rate. By increasing the risk will reduce the reward while increasing the overall risk. However, by finding the profitability peak, you are able to find the optimal point where the risk is worth the reward. It's worth noting that both the profitability percent and the dollar profit will peak at the same time, but the dollar profit will decrease significantly while the profitability only slightly. By following these guidelines and making adjustments to your risk management strategy, you can optimize your trades and increase your chances of success in the market while maintaining a favorable risk to reward ratio. We hope you've learned something about the risk-to-reward ratio and how the Walk Forward Algo Trading program can help you manage it. Thanks for watching.